Imagine this. You swipe your credit card for a simple $20 purchase, maybe food, fuel, or online shopping. But here's the twist. Credit card companies don't make money just once from that swipe. They make money multiple times from different directions. And now, former US President Donald Trump wants to shake the entire system by saying credit card interest rates should be capped at just 10%. Sounds great for consumers, right? But banks are calling it dangerous. So today, let's break it down simply. How do credit card companies actually make money? And would a 10% interest cap really help people or create bigger problems? First, let's clear one basic confusion. Every credit card has two important players. The first is the card issuer. This is the bank that gives you the card, sets your interest rate, credit limit, and fees. Think of banks like Chase, Capital One, or Bank of America. The second is the card network. These are companies like Visa, MasterCard, American Express, and Discover. Card networks don't lend you money, they simply run the payment system that moves money between your bank and the store. Some companies like American Express and Discover are both the issuer and the network. Understanding this difference is important because money flows through both sides. Now let's talk about the first way credit card companies make money, processing fees. Every time you use your card, a fee is charged in the background. This is called an interchange fee. The store's bank pays this fee to your card's issuing bank, and the store usually covers the cost. That's why some shops add a credit card surcharge, give discounts for cash payments, or set minimum purchase limits. Even if you pay your credit card bill in full every month, banks still earn money from your swipe. The second and biggest moneymaker is interest. This is where the real profit comes from. If you don't pay your full balance each month, the bank charges interest, also known as APR. Today, the average credit card interest rate in the US is over 22%, and credit card interest compounds daily, which means interest is charged on interest. According to Federal Reserve data, nearly 80% of credit card profits come from interest alone. This is exactly why banks are nervous when politicians talk about interest caps. That brings us to Trump's proposal. Speaking at the World Economic Forum, Trump urged Congress to cap credit card interest rates at 10% for 1 year. Consumers love the idea, but banks strongly oppose it. Jamie Dimon, the CEO of JP Morgan Chase, warned that such a move could be an economic disaster. Banks argue that if interest income drops, they'll reduce lending, especially to risky borrowers, small businesses, and low-income families. In short, cheaper credit could mean less access to credit. But interest isn't the only way banks make money. Even if rates are capped, fees still bring in massive revenue. These include annual fees that can range from under $100 to more than $800, late payment fees that can go up to $40, balance transfer fees of 3 to 5%, foreign transaction fees of up to 3%, and cash advance fees, which are often the most expensive of all. So even with lower interest rates, fees ensure the money keeps flowing. So what's the real takeaway? Credit cards themselves aren't evil, but using them carelessly can be extremely expensive. If you pay on time, pay your balance in full, and avoid unnecessary fees, a credit card can work in your favor. But if you rely on minimum payments and ignore interest and fees, you're not really the customer, you're the product. Now, the big question is yours to answer. Is a 10% interest cap a smart move to protect consumers, or a risky decision that could backfire? Share your thoughts in the comments, and if this video helped you understand how credit cards really work, don't forget to like and subscribe.